I don't think there's any political will to go through that kind of a liquidation, cleansing, whatever you want to call it, cycle. I don't think there's any political will for that. I'm going against what everybody else says. I mean, pretty much the people that are the central planners that run the Fed and their most strident critics pretty much all agree on the basics of the theory. And I'm coming from out in left field and saying, no, you all got it all wrong. Here's how to understand this. We're pretty confident that the price of gold would be north of 2,300. And here we are over 2,200 already. The time report's basically coming out.
Hey guys, welcome to Capital Cosm. Today we have a special returning guest in the form of Mr. Keith Weiner. Keith, thank you for coming back on the show, my friend.
Thanks for having me, Danny.
As always, guys, nothing in this video is financial advice. Neither Keith nor I are financial advisors, so please do your own due diligence. Keith, let's kick things right off and get your general outlook for the markets as a whole right now. Broadly speaking, what's your general view of the markets?
I think the interest rate is going to come back down, whether Powell wishes it or not. He seems to be pretty good at giving ambiguous signals, to say the least. But I think there's some very powerful forces that have been in operation for the last 40 years or so, and he's not bigger than those forces. And I think, and I've been saying this for a long time, when the interest rate slams back to zero, then that is likely to be a boost for the price of gold and silver, unless we're in a 2008 type crisis. So if he's cutting into a crisis of the sort where companies are collapsing and banks are collapsing, then that's a different scenario. But I think right now there's a big opportunity cost of holding gold, because outside of monetary metals, anyways, that's what we do, is pay interest on it. Outside of monetary metals, you don't get interest on gold, but you get 5.5% on T-bills. So that's a pretty strong inducement to go to T-bills for most people, not everybody, and therefore that pulls them out of gold. But when T-bills go to zero, then that opportunity cost disappears, or both of them don't pay a yield, and therefore people are going to prefer gold more. But that can take a while to play out.
Yeah. Gold's at $2,206 at the time of this recording. I believe that's an all-time high, isn't it? Or at least close to one. Yeah. Yep. So I've got your gold outlook report for 2024 up. We can go through some of these charts here. First thing I want to look at is this current dynamic versus previous dynamic, in a sense of then versus now. How are things similar? How are things different when it comes to the precious metals? Go ahead and share my screen so the audience can see. But here's what we got. So you've got this Fed funds rate chart, and walk us through some of your commentary here. What's different? What's the same? Go ahead, Keith.
So this is a very long-term chart, going back many decades, and you can see the incredible spike in interest rates around 1980 or 1981. So after World War II, we had what I call the rising cycle, and there's a positive feedback loop and a ratchet effect between commodity prices and consumer prices and interest rates. And what you get is essentially corporations borrowing ever more to chase up the interest rate. The more the interest rate's going up, corporations are borrowing more and more, because there's a greater and greater return on carrying inventory, because the value of the inventory, at least in nominal terms, is rising. That finally breaks in 1981, and we've had a 4 decades long fall in interest rates. Every once in a while, the Fed thinks, and you can see the spikes where the Fed thinks, oh yeah, we can try to reverse this. Kind of like falling into a black hole. Every once in a while, they light the rocket boosters to try to get out of the gravity well. If you scroll that thing to the right, you'll see, where we currently are in the, just scroll that to the right a little bit. Yeah, you can see how they made this incredible spike in the Fed funds rate, and I just don't think that's gonna work. Now, one comment I always make about this: the reason why they're doing this is to try to address inflation, so-called, which they define as rising consumer prices. There are many, many, many harmful, deleterious effects of falling interest rates. But if one were willing to ignore all of those harmful effects and focus only on consumer prices, which is what the Fed has two mandates: consumer prices and employment. Um, and they hiked, knowing that would actually harm employment, um, but they were doing so to protect, to try to reverse inflation on consumer prices. If one was only concerned about consumer prices, one should want a falling interest rate, because every time the interest rate ticks down, that is a fresh new incentive for every productive enterprise to borrow more to build more productive capacity. So suppose you're in the hamburger business, you have 50 stores in your chain. You always have a business case for the 51st store sitting in your pocket. And that business case, it's the marginal store, so that's the one that the bottom line is red. You don't think you're going to make any money on it. And unless more people move into that town, or unless the appetite for hamburgers increases, that's the store you don't build. But if they cut the interest rate, they cut one of the biggest expenses on your spreadsheet, which is the interest expense. And so suddenly the spreadsheet will flip from red to black ink when you say, let's build it. And the same thing with the companies that make hamburger grilling equipment, the companies that make plate glass windows, the company that makes commercial ceramic floor tiles, everything you need in that store. That, the falling interest rates, not only their signal, but their additional incentive to borrow more to expand capacity. So that's why you get, if not falling prices, you get at least soft prices during a falling interest rate period, where people say, after 1981, oh, inflation was tamed. Well, that's why, because the interest rate's falling. So now, they spiked interest rates. We did on our podcast, I guess this was a couple of years ago, before they started hiking rates. So this must have been October of 2021. In honor of Halloween month, we had a zombie month. And the Bank for International Settlements defines a zombie corporation as a corporation whose profits are less than its interest expense. Now, interest can only be paid out of profits. So, if you're making $1, but your interest expenses are $2, you're in deep trouble, right? And so that's only possible due to not only really low interest rates, but very forgiving, very permissive, if not promiscuous, credit markets. Like, creditors are willing to lend you money, knowing that you literally don't have the profits with which to even pay the interest, even service the debt, let alone repay the principal. And according to the Bank for International Settlements, at that time, this is when interest rates were still zero, mind you, that something like 20% of all corporate debt was zombie debt. Now we've spiked from zero to essentially 5.5. What percentage? You've raised the margin. You haven't raised anybody's profitability. All you've done is raise the threshold. It's like raising the minimum wage from $10 an hour to $50 an hour. How many people are suddenly not employable because they're not worth $50? Or how many companies that used to be not zombie are now zombie because all you've done is raise the threshold? I haven't seen new data coming out. I've seen reports in 2022, but largely is covering the historical zero interest rate period. So it'll be interesting to see what happens. But I think the only way this resolves, well, there's two ways. Either the Fed is going to reverse its interest rate policy and slam it back to zero, which they're sort of signaling they're going to cut. Nobody's saying they're going to cut to zero, but why would you cut at all unless you're at least worried about the possibility? Or what has to happen is the return on capital across the economy has to be greater than the cost of capital. It's not sustainable to be borrowing at, right? So no one can borrow at the T-bill rate. If you're in business, you're borrowing at 6.5% or 7 or 8%. Your return on that capital has to be greater than that. And since there's no way to just magically make your return on capital higher, it is what it is for structural reasons. The only way that goes up is by you or a lot of your competitors declaring bankruptcy, going out of business, liquidating productive capital, closing all those hamburger stores, closing all those plants that make ceramic floor tiles and plate glass windows, grilling equipment, and everything else, destroying so much supply that even though demand will obviously be dropping like a brick because all those people are getting laid off in this catastrophe, you have to destroy supply even more and even faster, such that those few surviving businesses are finally producing a return on capital greater than whatever the administered cost of capital rate is. So if we want to administer it at 5% and businesses are therefore paying 8, well, we have to get the return on capital up to 10%. That would require such mass liquidations. I really don't think there's, even if that was the right policy move, which I do not concede, I don't think there's any political will to go through that kind of a liquidation, cleansing, whatever you want to call it, cycle. I don't think there's any political will for that.
So in the 1980s, I'm assuming there were a lot less of these zombie companies than there are today.
Right.
And is that the reason why, despite making new all-time highs in the stock market, gold hitting all-time highs, Bitcoin hitting all-time highs, you have all these liquidity indicators, shining bright, but nonetheless, the Fed is still signaling to cut 3 times this year, despite all that. Is is that what you're saying is the reason why the Fed is
you're gonna
being
have to
more
cut.
dovish, is because they see the data that you're referring to?
Yeah, because defaults have to come. So just take commercial real estate, and there's partly a very big non-monetary effect, which is we had COVID, and with COVID came lockdowns, and enormous numbers of employees got used to working from home for a period of several years. I think that cat is now out of the bag. I mean, employers are trying to get employees back to the office, and I think largely with very mixed results. So what I think is going to happen is the average employer. I mean, no major corporation is going to say we're going to have no office and be completely virtual. They'll have offices, but the footprint of the office will be reduced by half or 2/3 or something like that. So there's a huge amount of office space that is currently vacant. More, but some of it is still being rented and paid for by corporate tenants that are eventually going to right size their office footprint. And so already there's trillions of dollars of lost value in lost real estate values. That is so many commercial real estate loans. The value of the property is way below the value of the loan. And so let alone when those loans have to be rolled over, because the way that everybody's coped with 40 years of falling interest rates is to borrow as short term as possible, right? So everybody's borrowing, let's say 2 or 3 year, terms, knowing that there's always another downtick. That was the game. Pavlov trained those dogs after 40 years every day, ringing that bell. Those dogs are very well trained. The rate falls, don't borrow long term, borrow short term. So all that debt has to roll. And, if they're already struggling because they have vacancies, at whatever 0 plus whatever the spread was at the time, now, none of it is justifiable at whatever the rate is going to be set to. And so they're all going to be turning the keys to the properties over to the banks. And that's obviously going to blow huge holes in the bank's balance sheets. And yeah, the banks would obviously be aware of this. And the Fed, banks would obviously make the Fed very aware of this. The same thing occurring on, corporate loans, leverage loans, all kinds of things don't work at these interest rates. And the Fed has to be eyeing that very nervously, regardless of whatever the lagging. I mean, employment's a lagging indicator. And one of the reasons is, there's been a lot of head fakes since the global financial crisis, where there's like recession, higher interest rates, and corporate employers let go of employees. They did layoffs because the conventional wisdom is, if there's going to be a cycle, and so you're coming along, and then the cycle goes down, and then you stay at the bottom for a while, and you come up. The key is to be laying off here, and so you're maximizing how much you're saving for this duration, and then you want to be hiring before your competitors when you get to the bottom and going up. And so there were any number of times where there was this head fake, where everybody thought, oh my God, we're heading into recession, things are bad, and whatever interest rates. So they would do layoffs, And then it didn't happen. And 6 months later, they're going back to the people they just laid off and begging them, please, would you come back and work for us? And paying them big bonuses and huge, increases in their old salary and so on. So employers have been burned. Pavlov was trained those dogs very well also. And so, there's been some layoffs recently, but not a to use the term bloodbath, certainly has not occurred yet. And in that, and anyways, I think that's a lagging indicator. Then you can look at things like credit card spend or GDP now or some more real-time statistics. So if employment is like looking out the rear view mirror trying to drive the car, some of these concurrent indicators are like looking out the side window. Well, what's coming ahead? To really understand what's coming ahead, you have to understand credit, because GDP, employment, those are consequences. Those are downstream of credit. And what I'm talking about is there's a massive credit catastrophe, coming at these interest rates. So either they're going to fix the interest rate or they're going to deal with the catastrophe and then try to fix the catastrophe. And we'll find out which.
Like a big deflationary event. What, right?
Yeah, I mean, it's just, massive default, massive crisis. Yep. And this time around, I mean, the bones of it are set to be much, much bigger than what happened in 2008. And I don't think anybody's prepared for that.
Yeah. So in this gold outlook report, another thing that you have spotlighted on is the yield curve, and it being an indicator for a recession, more specifically when it uninverts, right? We typically want to see to kind of see a recession occur, the yield curve has to invert, and then uninvert is really when the recession kicks in. So I want to show this chart that you've got laid out here. This is the 10-year versus 2-year yield curve. And whenever the 10-year is less than a 2-year and then uninverts, the recession comes next. And that's what you've got here. It hasn't quite uninverted yet. So can you walk us through this?
That's looking at every maturity from, I think, 1 month all the way out to 30 years. And you can see that the longer maturities are much lower in interest rate than the shorter maturities, badly inverted. The argument I'm making is that, people look at, and I call right there, it says oversimplification. They say, okay, if it inverts and then it uninverts, recession comes next. And they're just observing, I guess it's the old correlation, equals causality kind of mistake. And I'm saying, look, you got to really understand, okay, what does uninversion mean? And uninversion either means somehow suddenly the long end goes to higher and higher interest rates, or the shorter end finally is pulled back to zero. So if they start reversing their policy, this will uninvert by pulling the short end down below, the long end is at 4% something, right? So if you pull the short end down to 2%, well, you'd uninvert it. Now, there's only one reason why the Fed would be doing that. I'm arguing that's because they see a credit event either happening already and they're reacting in reaction mode to it, or they anticipate one. And so there's your recession, which is downstream of credit. The elephant in the room is, why the hell is the 10-year rate so much lower than the 1 month rate or 2 month rate or 2-year rate? What actually causes this? And my argument is that, the Fed administers on the short end. They administer the Fed funds rate. That's just dictated. Whether it's right or wrong doesn't matter, because the whole point of having a central planner is to substitute the judgment of a bureaucrat for the decisions of hundreds of millions of people in the market. That's a feature, not a bug. That's the actual whole point of the exercise, is we can't trust 300 million people to make proper decisions. We have to have a bureaucrat who's smarter, wiser, far-seeing, less corruptible, whatever it is. So, he's administering this interest rate on the short end, and that influences, they're dictating the overnight rate. That obviously has a very heavy influence on the 1 week rate, the 1 month rate, the 2 month rate, even the 1-year rate. But the farther out you go, the less influence he has. There's more market forces operating on the longer end. And on the longer end, the rate's not coming up. Now, people try to frame this in terms of, well, market participants are betting Like they frame it as everybody's a speculator in the market, and all the speculators think that the Fed's going to have to reverse. I don't think that's it. And the Fed obviously hasn't reversed. We're now 2 years plus into this hiking cycle. People that are just betting, I mean, it's a short-term trade. That's not it. On the longer end of the curve, that's where businesses issue, bonds. That's where credit, like business credit occurs. And my contention has been, I mean, and when we were in zero interest rates, I've been writing this since, over a decade. The demand for business credit is very soft, except for on each fresh new downtick in interest rates. Every time the interest rate goes down, there's a fresh wave of borrowing because that's when everybody's spreadsheet, flips from red to black. But when the interest rate goes up, those participants leave the market. So where's the issuance of all the 10-year bonds, other than the government, the Treasury in cahoots with the Fed can decide how much 10-year bond issuance versus how much 1 month bill issuance that they want to do. It's a matter of attempting to engineer the curve for whatever central planning objectives they have. But businesses aren't by and large out there seeking fresh credit. Nobody has a return on capital to justify the cost of capital nowadays. So without the issuance, maybe buyers at that end of the curve are soft, maybe not, but issuance isn't there. And so without anybody pressing on the bid, selling those bonds, you see this inversion. And, again, a signal that the Fed is attempting to do something, attempting to fight the market forces with this interest rate hike. I don't know if that makes any sense. Obviously, monetary theory, series of interest are complicated, and mine is counterintuitive in part because I'm going against what everybody else says. I mean, pretty much the people that are the central planners that run the Fed and their most strident critics pretty much all agree on the basics of the theory. And I'm coming from out in left field and saying, no, you all got it all wrong. Here's how to understand this. And so what I'm saying is out in left field for that reason.
Gotcha. So I think we've covered the what exactly is happening. Let's go ahead and cover the then what. So what does this mean for gold and silver prices? In the same report, you've got gold and silver price predictions for 2024. I want to pull up some charts here that you've got laid out. All right, so you've got the gold market bid as well as the fundamental price. Walk us through what this chart indicates.
So as you see, the date of the chart was February 29. The one of the hazards of this business, if you want to publish stuff, especially if you want to make it look good and format and pretty and all that, is your marketing team takes a while. So this report came out last week, but at the time that this was written, and I did most of the writing even earlier in February. So the hazard is that by the time you put it out, it's stale, and you called for higher prices, and one of two things has happened: either the price has crashed and you look like an idiot, or the price has really gone up, and then your prediction is kind of overcome by events, and people are like, well, Keith, that wasn't much of a prediction. You wrote it and it's already happened, but this was written quite a while ago. So the graph ends on February 29. So there's a bid and offer, but and so technically that's the bid price on gold, spot gold. But bid and offer are so close. They're 10 to 50 cents apart. If we were to draw both the bid and the offer on the same graph, it would look like the same line, because on a $2,000 price, you can't see 10-cent spread. So that's showing where the price is. If you can just I just can't quite read. What were we at? Just over $2,000 at where the graph ends.
Yeah,
$2,040 or something like that probably is when that ended. And so that's just what the price was. Everyone knows that. There's no new news there. And then you can see what we're calling the fundamental price, and I'll explain what that is at almost 2,400. So everybody's got their model, right, of what they think the price is going to do. And most people try to do some sort of macroeconomic analysis which falls in largely into two categories, I guess three categories. There's the supply and demand stuff, well, how many miners and how much jewelry demand, and all that kind of stuff. Number one. Number two is the real interest rate versus nominal interest rate kind of stuff. And number three gets a bit more technical. You're looking at the commitment of traders report, open interest, ETF flows, and that sort of thing. And in the report, we talk about why these types of analysis don't really work. But in short, it's because virtually all of the gold mined, I used to say in 5,000 years of human history. Last year, I don't know when this find occurred in archaeology, but I read the article last year. There was a find that dates back to about 6,500 years ago to some cave in Bulgaria where they found some warrior king that was laid out with like 7 kilos of very ceremonial gold. Like he had a rod and scepter and all kinds of things. So, for 6,500 years, let's say, gold has been highly prized. It never gets thrown out. And if it's fashioned into an object that's no longer useful or needed, it's just melted down and cast into something new. Virtually all the gold mined in that period of history is still in somebody's hands. And so, if one party sells it, that means another party's buying it. If one party buys it, it means another party selling it. So there's this vast ocean of gold liquidity, and a wave can slosh from here to there. So this part of the ocean is going up, this part of the ocean is going down. It doesn't really.
Hey guys, quick pause. I won't take too much of your time, but I just wanted to let you know that if you want to use and read the same newsletter that I do, Capitalist Exploits, we have a special $1,000 discount exclusively for Capital Cosm viewers of this channel. You simply have to click on the link down below, get your $1,000 discount. Super stoked about this. I discovered Chris and Brad's newsletter, Capitalist Exploits, 4 years ago. It set me on my investment journey. I attribute a ton of what I know to that newsletter. So if you haven't already, check them out. Click the link down below to learn more. Take advantage of this $1,000 discount. You're not going to find it anywhere else. All right, now let's get back to the video.
There's no predictive power to that sort of analysis. And I think a lot of them really end up being, nothing more than taking a straight edge of a French curve to the price chart and just, drawing your pencil along and say, this is what our price prediction is going to be. We actually did that one year and said, we think this is probably the best way to predict next year. I don't remember if that one ended up being accurate or not. Every once in a while, we give ourselves
What
a
year
report
was it?
card. I don't remember what year that was. It was several years back. Every once in a while, we give ourselves a report card and look at all of our predictions because we've been doing this for, since I think 2012. And I had a private letter before that when I was doing this. So we look at it. So, how did we get it? I think we got a B on our report card the last time we did that. But anyways, our fundamental model is quite different because our analysis is based on looking at spreads because, price can move around for all sorts of reasons. And the price chart almost looks random. There was a guy on Twitter the other day that said, here's 4 price charts. Here's 4 charts. 2 of them are real prices in a real market. 2 of them are random. Can you tell which is which? And they weren't labeled. And I just threw my arms up and I'm just like, ha ha ha, you can't because it's random. But when there's a spread in a market, spreads are much more consistent. They don't move around randomly. When a spread changes, if you understand the market, then the movement of the spread, you can really glean some real insight into it. So we look at the spread between future and spot, which is a lot of different things I've written. I don't know how many umpteen gazillion words over the years as to why that's an interesting spread to look at. But at its very simplest level, if the price of gold goes up and the spread between, so future minus spot, you look at the near month, futures contract. So right now here in March, no one's really trading April anymore as of March 20. We're just about the first notice day. So they're trading June gold would be really the active contract right now. So we look at the June gold price and we look at spot and say June minus spot. And June, normally the futures contract is above, spot. So future minus spot's a positive number. We look at that spread, quoted as a percent, an annualized percentage rate, sort of like a yield. Meaning if you were to buy spot gold and sell June, so you're buying spot gold at the offer price and selling June gold on the bid price, what percentage versus the price you have to pay to buy the spot right now. What is that as a percentage if you annualize that and you compare that to T-bills or any other annual yield you want? But at the very simplest level, if that spread is widening and price is going up, it's telling us that it's the buying of futures that's leading the way. Right? So every time somebody bids at futures, there's a market maker that will arbitrage and buy spot and sell futures. That's how that market works. And so, spot will be pulled up reluctantly by the arbitragers, but it'll be sort of lagging, and the spread will be widening. So imagine there's a coiled spring connecting between future and spot. You're pushing up futures. Well, spot is coming up with it, but the gap is widening. So what's really notable right now, and we'll get back to our fundamental price model. What's really notable right now is we've had a big run up in price. Now I've been on airplanes the last few days. I haven't seen it in the last few days, but generally in this whole big run over the last, let's call it calendar 2024, there's not been a widening of that spread. And that is very different from the pattern. I mean, people used to call me a perma bear for all the years between 2012 and let's call it 2018, 2019. Every time the price would blip up, I'd be out there with a chart showing that it's people in the futures market using leverage, i.e. short-term speculators, attempting to front run what they imagine is going to be this massive price rise because of something that Bernanke or Yellen or Powell would say, and they'd get all excited, they get all hot and bothered, and they'd hit the buy button, and you can play with big leverage in the futures market. It doesn't take that much capital to command a lot of notional value of gold when you're playing with 20-to-1 leverage. They'd bid up futures, and I'd be like, this isn't going to last. And I did charts showing the half-life, and you get this big blip, and how long does it take to decay back to, right back to where it was? It's all noise. And that was the pattern for a lot of years. And people didn't like me saying it. On the other hand, I was right. And we obviously didn't get the big bull run, the moonshot that everybody was hoping for and calling for all during those years. Now, what we're seeing is it's not a widening spread between futures and spot. That's not what's going on right now. This is buying of physical, not buying of futures. So what our fundamental model is attempting to do is by looking at the spread and looking how the spread moves in response to price action, we're attempting to back out the speculators and say, okay, the speculators can put tension in the market because they can play with so much leverage, and they can either pull the price above where it would be. So think of like two pins, right? And there's a rubber band stretch fairly tight between the two pins. Sometimes the speculators are pulling it up, but there's a tension there, and that's kind of what we're measuring. And there's other times when they're pushing it down, they're just depressed and they think that gold price is going to crash, so they're shorting it in the futures market. And so we're attempting to say, okay, how much tension is there? If we back out the tension, let it be neutral, so there was no futures market effect on the price, where would the price be trading? And right now, what that chart is saying is the price would be, as of February 29, $2,400. I can look to see what it is right now.
How much would it be?
I'm just looking at the graph you had on the screen there, as of February 29. Looks like it was just under $2,400.
Okay.
Just that, on that particular February 29 chart. Let me pull up the current one as of as of the 19th. Yeah, and the fundamental price has basically moved up with the market.
Do you want to share your screen, Keith?
I can do that. Do you see that chart?
Yep.
So you can see it. Do you see where my cursor is and the red line as I'm moving around? The graph is live on my screen. So we were there February 29, right? And now the price has moved up. This yellow curve has moved up, and we see the fundamental curve has moved up almost the same shape. Obviously, there's this exaggerated dip here. But here we are at just under 2,500 as a fundamental price at this moment in time. So it's saying that as the price has moved up, it's been driven by buying the physical. Now, I'm going to stop my screen share here so I can see the video view again. It is absolutely the case right now, and any honest dealer will tell you this, that retail demand for coins and bars in the West, let's say the United States, Canada, Western Europe, I think a little less so, Germany, and Austria, because they have more connections to the East, but certainly Western Europe, Australia, New Zealand, demand is moribund. It is not a good time for the dealers at the moment. Volumes are down, premiums are down, margins are down. It's not good. There's not a lot of, I don't think there's a huge amount of selling. I don't think a massive amount of metal is coming back from retail to the dealers, but I don't think people are buying right now. Probably because they're like, oh, I want to get a pullback. They're bargain hunters, probably. But I'm trying to read into their psychology. May or may not be right. But what I can tell you, and I've observed it, is demand in Turkey, demand in the Arab world, and demand in India is going gangbusters. And we know that demand in China is also high, but China has very bizarre capital controls and gold import limits. And so they're not allowing arbitrageurs to buy London and sell into Shanghai because they're not allowing enough gold in, so that there's a Shanghai premium. Which it's not that China is true price discovery, rather it's that it's the central planners in China have interfered with price discovery by not allowing China to import. But you have probably four different reasons. If you say, let's say China, India, Turkey, and the Arab world, four completely different drivers. In Turkey, you have let's take India first. In India, you have two things that are basically perpetual. One is distrust in their currency. Nobody regards it as a vehicle for savings, and love for gold. And the other is, the Indian currency goes down quite a lot. I think it's about 7% per annum against the dollar. It's not like the dollar is necessarily going up. I mean, the dollar is designed to be debased. The Fed's policy is 2% annual debasement for the dollar. And the rupee is going down 7% against that. So buying gold is a pretty sure thing in India. And they have appetite for it. And at least when the monsoons are good, have the disposable income, the Indians consistently turn to buy gold. And it's always been that way. And right now they have that disposable income, so they're doing it. In Turkey, you have arguably incipient hyperinflation. And having been to the Grand Bazaar in Istanbul, I can tell you, boy, there sure are a lot of gold shops. I'm told I had a guided tour of that, and I'm told by the Turk who guided me around that there's a lot more gold shops than there used to be, and a lot less textiles and spice merchants and other things to make room for all the gold shops that are going on there. I probably saw close to 100 gold shops. There was one Bitcoin kiosk of some sort, and all of that, just to put that in perspective. So, anyways, they're buying because their currency is potentially on the verge of collapse. I'm told that everybody in Turkey, if they have any money at all, would have at least 10 grams, roughly a third of an ounce, and the average person would have a heck of a lot more than that. Keeping in mind, wages are much lower there than the United States, so that's pretty remarkable. Because I don't think 1% of Americans have any gold, but the Turks all do. Now, in the Arab world, a lot of these countries, take UAE, for example, but a number of others, they have a currency pegged to the US dollar. And unlike a lot of other currency pegs, let's say Latin America, those currency pegs are rock solid, stable, and have been stable for many decades. Table flat, stable. If you're in UAE, there's no reason for you to wake up today and worry about the dirham going into some sort of death spiral, versus if you're in Argentina, even if you're at a moment in time or Venezuela or whatever, where they're declaring a peg. Nobody trusts those pegs, and those pegs are set and reset all the time. But in UAE and some of those other countries, those pegs go back many decades and the table flat. And yet people are buying gold like it's going out of style. Well, for a couple of reasons. Yeah, there is a Arab and also an Islamic affinity with gold, and it's a religious duty in Islam to own some gold. But in addition to that, they're thinking of gold in a different way. And I think a lot of the people are coming to the realization, they don't like the dollar, even if in a lot of cases they may love America, they may not. They don't really like the dollar because they're on the short end of the stick. The dollar is not working to their advantage. But there isn't any other paper currency that's going to work. Nothing else comes remotely close. So, but what can replace it? Oh, it's gold. And so the people are turning to gold there. And what I've found is I have a more sophisticated understanding of gold. It's not something you buy hoping the price is going to go up. But I saw something on Twitter, I think it was yesterday, where somebody said that the problem with people who buy inflation hedges is the moment they buy the inflation hedge, they want the inflation hedge to go up. Then all the inflation hedgers become inflationists. They're cheering for they want to see gold at 5,000, Bitcoin, whatever, 5 million. And so psychologically, it's kind of an interesting phenomenon. But they're looking at gold in a more sophisticated way. They see it as a capital asset. They see it as something that they want to generate a return on it. They want to be able to leverage it. They want to be able to trade it against other capital assets. That they're just light years ahead of Americans in sort of grasping it. And then I think in China, there's just a distrust of the authorities. There's a distrust of their currency. They have capital controls. I mean, they're all like animals that are kept in a pen, and the pen is locked, and they're not allowed to get their money out. And everybody's constantly looking for cracks so they can slip, a little bit of money out. And gold is one of those things where if you're holding gold in your hand, it's not an account. The authorities can't measure it or see it as easily. And so, they're turning to gold as a sort of response to authoritarianism. The same reason why they buy Bitcoin, I suppose. So, 4 different regions all buying gold as much as they can anyway. Turkey also has limitations on imports. Buying gold as much as they can, but for 4 different reasons. And that's more than enough to counterbalance the lack of appetite coming out of the West right now.
Yeah. So in addition to gold, we also have silver. What most people don't know is that before we had a gold standard, we had a silver standard in the United States. What about silver's adoption worldwide? Are you seeing the same level of demand for silver as we are for gold? Now, keep in mind, gold's hitting all-time highs. Silver is still about 50% off its all-time highs.
Right. And that's exactly what I would say I see internationally. I mean, right now it's in the news that silver imports to India are way up. So some people may turn to silver as, okay, if you can't afford gold or you can't get very much gold for your rupee, you can get a heck of a lot more silver. And, silver has always been the junior monetary metal, for that reason. I also think that gold is much more of a pure capital asset, and it trades against other capital assets. So the class that owns, whether it's shares or properties, paintings, fine whiskeys, whatever, antique Ferraris, that's a relatively small class, especially in a place like India. That class, regards gold as one alternative amongst those other alternatives. But for people that are working for wages, which is in India a much larger class, gold is almost out of reach. If you want to buy really small, you can get today Istanbul Gold Refinery, and and obviously we have a client in the form of Valorum. You can get forms of gold that are 1/10 of a gram or even 1,000th of an ounce. So 1,000th of an ounce would be $2 worth of gold plus the manufacturing premium of making such a product. The problem is manufacturing premium is quite high. So gold's not a particularly good deal in really small quantities. But so let's say you're in the US and you want to set aside 10% of your weekly wage, and your weekly wage is $500, $800, something like that. So you're looking at $50 or $80 you want to put into metal. Well, if you want $50 or $80 worth of gold, not only is it a bad deal, you're giving up a lot to a premium, but you're getting, a tiny little. Have you ever seen these little, 1 gram or 10th gram bars? Call them bars, basically little chips. You really wouldn't want to hold it in your hand. I mean, you'd lose it if you put it in your pocket. You'd lose it in the lint in the corner of your pocket. So they come in
Comes in
what's
like
called
this, like this. The
card.
packaging is like 100 times bigger than the actual product.
It's like the size of a credit card, and there's a little clear plastic window in there, and then this little chip is floating around in the window. It's not very emotionally satisfying. But if you want to buy $50 or $80 worth of silver, that's a handful of hefty, coins, 2 or 3 or 4, silver 1 ounce silver coins. And so I think wage earners, and this has been true for thousands of years, wage earners tend to use silver. But wage earners are under much more pressure versus capital asset owners right now. Capital asset owners in relatively good shape, and wage earners are, especially globally, under a lot of pressure. And so that's why you see silver, half of its all-time high, and gold making new all-time highs in dollars. Let alone gold is making new all-time highs in all the other currencies, which are going down against the dollar. And look at the Japanese yen. Yesterday, the market didn't like that. Ironically, didn't like that they're going to have higher interest rates in Japan, or maybe didn't believe that they're going to be able to make it stick after all these decades of zero rates and negative rates. Yeah, we're going to have positive rates now. Yeah, good luck with that.
Yeah. So to kind of wrap things up, I see you've also made some predictions for both gold and silver. Go ahead and walk us through what those predictions are.
So, as I said, one of the hazards of all this is you write this, and then either you look like an idiot by the time the report comes out because the market reversed hard, or most of what you said was going to happen by the end of the year happened. I think we said we're pretty confident that the price of gold would be north of 2,300, and here we are over 2,200 already. At the time the report's basically coming out. So that's going to kind of look like a nothing burger of a prediction, anyways. But I feel pretty confident of that. And silver, I think we said over $26 seems likely, and now here we are at over 25. So once again, falling to that hazard. But I think the overarching, let alone this analysis of the last couple of months, which is the price is now being driven by buying of metal, which has not been, I cannot overemphasize that. That's not been the pattern that we've seen time and time and time and time and time again, dozens and dozens of times going back to 2012. Every blip has been a widening of that future spot spread. And it's not the case now. But leaving that aside, I just don't think we're in, let's just say your father's gold bear market of 2011 or 2012 to 2019. We're just not in that environment anymore. We're now that was to sell the blips environment. And if you wanted to trade it, I think we're going to buy the dips environment now. I think the drivers are different. The psychology is radically different. Other parts of the world have engaged that were disengaged. I mean, for a lot of those years, India wasn't in a position to buy. There was a lot going on that's quite different now. Yes, central banks are buying. That itself doesn't, and we argue why in the report, doesn't really tell you a lot. But I just think we're in a different environment now, and that's a bull market. And so bull markets tend to be kind to, even if you get the timing slightly wrong when you buy, the bull market will make you right in the end. With my ironic or sardonic comment about, once you buy gold, you become an inflationist. I guess that it is worth saying something I used to say a lot of. You can't get rich by buying and holding gold.
Yeah,
gold doesn't go up. It's only the dollars which we measure it. So if gold is imagine you have 2 GoPro cameras. One of them you mount at the top of a cliff. The other one you attach it to a brick, and you throw the brick over the edge. And that brick is the dollar. So while the dollar is going down, the GoPro camera on that brick is looking up at the top of the cliff saying it's going up. You're not actually flying or rising anywhere by standing at the top of the cliff. You just simply avoided falling. You don't get rich in gold. You just simply avoid losing anything. And if you hold dollars, you're taking losses of whatever magnitude those may be. Silver, if you time it right, getting into gold and silver, yeah, you can make a lot of money because silver has a lot of volatility. But gold is just it's money. It's the thing you hold when you don't want to take a risk. It isn't going anywhere. You're not going to get any richer. But the good news is you're not going to get any poorer, which is rather the whole point.
What about playing the equities, whether it be in gold and silver, given increasing input costs and kind of dampening their upside? Are the equities still a good prospect to play?
I've over the years tended not to say very much about the equities. For one thing, it's a little bit outside my area of expertise. I certainly don't follow them professionally. And also, the obvious fact, if you look at the charts, is that equities have underperformed the price of gold on the way up and on the way down, and that's at least a 30-year, trend. And so, when the price of gold goes up, often that also means the price of oil is going up, and that's probably the single biggest input into the cost of mining. But the other thing that happens, depending on what part of the world you're in, is that there's only a certain amount of labor available for mining. And if all the mining projects are suddenly staffing up because the price of gold has blipped up, then the price of labor can be bid up to truly gobsmacking levels. And I remember this statistic is a few years old now, but this is sort of coming out of COVID in Western Australia. Somebody telling me what labor looked like. Now, this is Australian dollars, so, lop off approximately a third to get to US dollars. But so some of these mines are way out in the middle of nowhere. So they set up these mining camps. And so they'd hire a girl to, cook and clean the bunks, and she's being paid like $150,000 a year. And truck drivers are like, $200,000 or $250,000 a year. So labor tends to go way up, and especially in a place like that. It's very inelastic. You're not going to persuade a lot of graphic designers to leave Sydney and move out into the bush in Western Australia, no matter what the wage is, to sort of ruin your career and do that. And so you have that problem. But then when the price of gold comes down, the wages tend to be sticky. It's very hard to go to everybody and say, yeah, you know how you guys really held us up and hijacked us for higher wages when the gold price was up? Well, we're taking that all back. We're giving you guys all pay cuts now. You decimate your workforce, not to mention destroy morale. So, costs are sometimes sticky on the way up and, or sticky down. They don't go down, but they tend to rise rapidly as things are going. It's hard to manage the costs in that environment, in addition to all the other, geology risks and mine engineering risks and floods and cave-ins and all that. So, I don't want to be too negative on it. If you find the right play, obviously you can make a fortune, but certainly not for the faint of heart.
Definitely. Well, hey, thank you so much for coming on, Keith. Where can people find you?
So I'm at Real Keith Weiner on Twitter. That's KEITHWEINER. Unfortunately, there's an awful lot of bad guys out there that like to, steal my picture and create fake accounts that are, KIETHWIENER.
We'll have your Twitter handle on screen too. So,
yeah. And then the website, especially if people are interested in earning return on their metals, we have a 3.5% interest rate deal on gold right now. It's monetary-metals.com. That's metals with an S. Monetary-metals.com. And I have all these articles. We have the Gold Outlook Report 2024. There's tons of content.
Fantastic. Yeah, we'll have all that linked down below. Go check out Monetary Metals. Check out Keith. Follow him on Twitter. Keith, thank you so much for coming on, my friend. And if you enjoyed this content, be sure to give it a like, comment down below. Let me know what you think. I'll try to answer as many questions as I can in the comment section. No guarantees though, but if you subscribe to the channel, we'll be able to get more guests like Keith. So I would deeply appreciate it if you do. With that said, you guys, I will see you in the next episode. Bye, y'all.